Microsoft stock is trading live at $443.61 per share, down 3.67% in intraday trading as the middle of the week sees significant institutional rebalancing across the tech sector. This drop comes on heavy volume, with over 15 million shares changing hands in the morning session alone, showing a sharp departure from its recent upward trajectory. While retail investors are glued to the headlines coming out of the ongoing annual Build conference in San Francisco, expecting a massive product-driven pop, the big institutional desks are quietly fading the initial hype. This intraday dip breaks a powerful multi-day momentum streak that had previously pushed the equity well past its recent support levels, proving that despite bullish analyst upgrades hitting the tape with targets as high as $550, the public market remains highly sensitive to immediate valuation friction. The deeper reality is that while the public thinks this weakness is just an ordinary market fluctuation, the data shows an underlying tug-of-war regarding infrastructure expenses. Everyone expects the cloud business to keep expanding at a breakneck pace, but few are looking closely at how much cash is being burned to maintain that position. For months, self-investing platforms and online investing portals have blasted headlines about how software is making a massive comeback. Yet looking closely at the individual brokerage flows, large institutions have actually been trimming their exposure to mega-cap tech during recent strength. This creates a fascinating divergence between retail enthusiasm on popular retail apps like the Robinhood app and the cold, calculated moves happening behind the scenes on institutional execution networks. To find common ground, almost everyone can agree that this software giant is the definitive backbone of global enterprise computing. The general consensus across every major trading desk is that it remains a safe haven asset, an unstoppable compounding machine that belongs in every long-term portfolio. Investors use online investment accounts to accumulate shares blindly, trusting that its enterprise software dominance guarantees permanent growth. But if you challenge that standard belief with a contrarian take, you realize that the narrative has outpaced the short-term financial reality. The market is pricing this business as an agile, hyper-growth startup, ignoring the massive capital expenditure drag required to build out multi-billion-dollar data centers. When you analyze the real numbers, the margin pressure from hardware procurement is beginning to nick the clean cash flow profile that historically justified its premium valuation. Recent trading sessions have been an absolute roller coaster for the equity. After hitting tough lows back in March, the stock staged a fierce 30% recovery that caught a lot of short sellers completely off guard. That massive spring rally helped erase a significant portion of its early losses, yet the stock remains down roughly 7% since the year began, trailing several of its mega-cap peers. This recent price action highlights a critical structural shift. High-profile money managers have openly noted that the tech giant had actually become too cheap to ignore when it tanked earlier in the spring, which prompted legends of the industry to load up on shares heavily. However, now that the price has snapped back toward the mid-440s, the valuation is no longer an obvious steal, and the trading volume indicates that the easy money from that cyclical bottom has officially been made. Sector momentum has been wildly erratic, and macroeconomic pressures are compounding the volatility. High interest rates are making capital-intensive projects incredibly expensive, and every tech giant is feeling the squeeze. When you look at the wider market through the lens of a sophisticated interactive brokers platform, you can see that institutional positioning has rotated out of defensive software plays and into pure-play semiconductor businesses. The stock experienced a brief boost when a major chip designer unveiled a custom enterprise processor built in tandem with the company to power next-generation personal computers. But today's intraday drop shows that those hardware partnerships are a double-edged sword. The cost of acquiring these high-performance chips is skyrocketing, meaning the revenue generated from cloud subscriptions has to run twice as fast just to keep operating margins flat. Let us pause for a moment to gauge where this community stands. Comment below how many shares of Microsoft stock you currently hold in your portfolio and whether you are buying this specific dip or waiting for a deeper correction. Understanding the underlying mechanics requires looking directly at how the core business model functions. This enterprise operates through three massive segments that pull in staggering amounts of cash. First is productivity and business processes, which includes the ubiquitous Office suite, commercial cloud subscriptions, and its professional networking asset. Second is intelligent cloud, anchored by the massive Azure infrastructure platform, which has recently shown a spectacular 39% year-over-year expansion in its latest quarterly numbers. The third segment is more personal computing, which encompasses Windows licensing, device sales, and the Xbox gaming ecosystem. Historically, this model has been an absolute cash machine, yielding an operating income of over $34 billion in a single quarter, backed by an overall gross profit margin that hovers comfortably near 70%. The historical data underscores how we arrived at this valuation crossroads. For the fiscal period ending late last year, the company reported a massive total revenue of over $318 billion on a trailing 12-month basis, demonstrating an incredible capacity to scale even at a multi-trillion-dollar size. The balance sheet remains a fortress, showing a current ratio of 1.28 and an interest coverage ratio exceeding 54, which explains why conservative wealth managers favor it. Older financial reports confirm that the company has consistently used its operating cash flow, which topped $46 billion in recent quarters, to fund aggressive share repurchases and stable dividend distributions. This past performance created a deep sense of security among market participants, leading many to believe the stock was completely immune to broader macroeconomic shifts or cyclical downturns in consumer spending. Looking ahead, the future outlook depends entirely on the tension between market expectations and financial reality. The primary catalyst on the horizon is the monetization timeline for its newly embedded cloud applications. The market expects these corporate add-ons to immediately drop straight to the bottom line, boosting earnings per share significantly over the next 2 fiscal years. The reality, however, is that corporate IT budgets are tightening, and enterprises are demanding clear proof of productivity gains before committing to expensive long-term software licensing upgrades. If the adoption rate among Fortune 500 companies stalls even slightly over the coming quarters, it will trigger a sharp re-rating of the stock, as the current price leaves absolutely zero room for execution errors. Furthermore, execution risks are multiplying as the competitive environment intensifies. Major rivals are aggressively slashing prices on cloud infrastructure, turning basic computing power into a commodity and threatening the juicy margins the market takes for granted. There is also a brewing structural risk regarding how the company manages its high-profile outside partnerships. While its massive multi-billion-dollar investment in the world's leading independent artificial intelligence lab recently added billions in paper gains to its net income, any operational friction or regulatory scrutiny surrounding that relationship could severely disrupt the product pipeline. If regulatory bodies launch antitrust investigations into these tight tech alliances, the company could find itself forced to pivot its core engineering strategy at the worst possible moment. On the opportunity side, the enterprise retains an unparalleled distribution advantage that no competitor can easily replicate. Because its operating system is installed on hundreds of millions of devices globally, it can deploy new software updates and enterprise tools directly to commercial clients instantly. This massive footprint provides an incredibly sticky customer base that generates predictable recurring subscription fees. If the business can successfully transition these legacy users into high-tier cloud accounts without experiencing massive customer churn, the long-term margin profile will stabilize, allowing the company to easily outpace the broader software index and justify its premium pricing multiple once again. To wrap things up, the central insights today reveal a clear mismatch between what everyday investors expect and what the hard data shows. The general crowd views this stock as a flawless, bulletproof bet on the modern cloud economy, expecting uninterrupted upward movement based on conference headlines. The reality is far more nuanced, defined by surging infrastructure costs, rotating institutional capital, and intense competition that is actively chipping away at corporate margins. Today's intraday drop down to $443.61 serves as a stark reminder that even the largest balance sheets in the world are not immune to valuation corrections when short-term momentum runs ahead of actual cash flows. Navigating this landscape requires ignoring the superficial retail noise and tracking the real institutional volume trends that truly dictate where this enterprise is headed. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.